Richard thought he had retirement all figured out. 67 years old, 32 years with the same manufacturing company, a paid-off house in suburban Ohio, and a carefully built nest egg that he and his wife Linda had been disciplined about for decades. Every month, Social Security deposited $2,840 into their joint account. Every quarter, his old company pension sent a check for $1,100. And every year, like clockwork, Richard wrote a check to the IRS for taxes on that income. He paid because that is what honest people do. He never questioned it. He never looked up the rules. He just paid. Until one April afternoon, sitting across from a new tax preparer at a strip mall office, Richard heard something that made his blood run cold. The preparer looked up from the spreadsheet and said, "Mr. Carlson, you have been overpaying your taxes by about $4,000 a year for the last 6 years. $4,000 a year, 6 years, $24,000 that Richard had handed over to the federal government because nobody ever told him that much of that money was never taxable in the first place. $24,000. That was a new car. That was 2 years of property taxes. That was the difference between comfortable retirement and pinching pennies. And Richard just gave it away. Let me be blunt with you right now. If you are retired or planning to retire within the next 5 years, what I am about to tell you could save you thousands of dollars that you are currently giving away. And the worst part is, you are not breaking any law by giving it away. You are not committing a crime. You are just ignorant. And the tax code is counting on your ignorance. The IRS does not send you a letter saying, "By the way, you paid us too much last year." The state revenue departments do not call you up and say, "Hey, we noticed you moved here from a different state and you are filing under rules that do not apply anymore." Nobody is coming to save you from overpaying. That is your job. And today, I am going to show you exactly where retirees overpay and how to stop it. I am going to walk you through every major category of retirement income, tell you which exemptions you are probably missing, and give you a step-by-step action plan to get your money back. Let us get started. Let us start with the biggest one: Social Security. Social Security benefits are not fully taxable for most retirees. In fact, depending on your income, a significant portion of your benefits may be completely exempt from federal income tax. But here is the problem: most retirees have no idea how the math actually works. They assume that because they receive a 1099 SSA form, every dollar on that form is taxable. That is wrong. It is dangerously wrong. And it costs retirees billions of dollars every single year. The IRS uses something called your combined income to determine how much of your benefits are taxable. Combined income is your adjusted gross income plus any non-taxable interest, plus half of your Social Security benefits. If you are single and your combined income is under $25,000, 0 of your Social Security is taxable. 0 if you are married filing jointly and your combined income is under $32,000. Again, 0 taxable. Above those thresholds, things get complicated. But even then, at most 85% of your benefits are taxable, never 100%. I want to repeat that because it is so important. Never 100%, no matter how much money you have, no matter how large your Social Security benefit, at least 15% of it is always tax-free at the federal level. Let me give you a real example. Let us say you are married, filing jointly. Your combined income is $38,000. You might assume you owe taxes on most of your benefits, but the actual calculation says only about 50% of your benefits are taxable at that income level. If you have been filing as if all of it is taxable, you have been overpaying by hundreds, possibly thousands of dollars every single year. And if your combined income is right around the threshold, the marginal tax on your benefits can create nasty surprises. Every extra dollar of other income can make up to 85 cents of your Social Security benefits taxable, creating an effective marginal tax rate that is much higher than your bracket suggests. That is called the tax torpedo, and it hits middle-income retirees the hardest. And then there is the state level. 13 states tax Social Security benefits to some degree. The other 37 states plus Washington, D.C., either fully exempt Social Security or have no state income tax at all. But even among those 13 states, the exemptions vary wildly. Some exempt Social Security entirely if your income is below a certain amount. Some exempt it for everyone regardless of income. Some only exempt it if you are over a certain age. West Virginia recently phased out its tax on Social Security entirely. Missouri and Kansas have partial exemptions tied to income. If you are living in a state that taxes Social Security and you qualify for an exemption you did not claim, that is money you will never see again, and the states are not going to tell you. Here is where I want you to stop and think about something. Social Security is not welfare. You paid into that system your entire working life. Every paycheck, FICA taxes came out. For decades, you and your employer each paid 6.2% of your wages into the system. Now, when you finally draw that money back out, the government wants to tax it again. That is double taxation. And while the law allows some of it, the law also provides exemptions that you need to claim. If you do not claim them, you are voluntarily participating in your own double taxation. Stop doing that. Let us move to pension income, because this is where it gets really frustrating. Pension income tax treatment is a patchwork mess across the United States. Some states fully exempt pension income. Some partially exempt it, some tax it like regular income. And here is the kicker. The rules change when you move. So if you retired in New York, where your pension was partially taxed, and then moved to Florida for the warm weather, Florida has no state income tax. Your pension is fully exempt. But if you move to Pennsylvania, your pension might be fully exempt there too, but only if you know to claim it. Pennsylvania has what is called a pension income exclusion. You can exclude a certain amount of your pension from state taxation, but you have to file the right forms. You have to know it exists. The same goes for Alabama. Alabama allows a full deduction of retirement income, including pensions for residents over age 65. But if you are under 65, the rules are different. If you moved to Alabama at age 62 and filed taxes incorrectly for 3 years before turning 65, that is 3 years of overpayment that you could have avoided if you had just read the state guidelines. And the state of Alabama is not going to mail you a refund. They are not going to apologize. They are just going to keep your money. And here is the dirty little secret that the states do not advertise. Many states offer full exemptions for specific types of pensions: military pensions, police and firefighter pensions, teacher pensions, state and federal government pensions. If you served in any public capacity, your pension may qualify for special treatment that a private sector pension does not get. But unless you read the fine print of your state's tax code, you would never know. I talked to a retired firefighter in Colorado who had been paying state income tax on his pension for 8 years before a friend mentioned that Colorado exempts up to $24,000 of pension income for retirees over 65. He had never heard of it. His tax preparer had never mentioned it. 8 years of overpayment gone. That is nearly $10,000 in state taxes that he paid for no reason. And when he asked his tax preparer why she never told him, she said she did not know. That is the level of expertise you are dealing with. Now, Roth IRAs. This one should be straightforward, but people still get it wrong. Roth IRA withdrawals are tax-free if you meet 2 conditions. 1, the account has been open for at least 5 years. 2, you are at least 59.5 years old. If you meet both conditions, every dollar you take out of your Roth IRA comes to you completely free of federal income tax. Not deferred, not reduced, free. It never shows up on your tax return as taxable income. It never increases your adjusted gross income. It is as if the money never existed from the IRS's perspective. But here is where people mess up. They take money out of their traditional IRA or 401k first because that is what their advisor told them to do 20 years ago. Or they take a proportional withdrawal from both accounts. Or they let their CPA decide the withdrawal strategy without understanding the tax implications. And they end up paying thousands in taxes that they could have avoided simply by withdrawing from their Roth IRA first in certain years. Let me explain the strategy clearly. In years where you have a large, one-time expense, a Roth IRA withdrawal does not increase your taxable income. That means it does not push you into a higher tax bracket. It does not trigger higher Medicare premiums through IRMAA, the income-related monthly adjustment amount. It does not increase the taxable portion of your Social Security benefits. A regular IRA withdrawal does all of those things. So if you have both types of accounts, the order in which you withdraw matters enormously. Drawing down your taxable accounts in years when your income is low, and using your Roth IRA in years when you have extra expenses can save you thousands. But here is what really makes me angry. Some financial advisors still do not teach this. They give retirees a generic withdrawal plan without modeling the tax impact year by year. They set up a 4% rule and call it a day. That is not financial advice. That is negligence, and you are paying for it. Military and public service retirement benefits deserve their own section because the exemptions here are some of the most generous and most overlooked in the entire tax code. If you are a military retiree, many states offer full or partial exemptions on your military pension. As of 2025, over 30 states offer some form of tax break on military retirement pay. Some states, like Alabama and Hawaii, fully exempt military pensions. Others, like Arizona and California, offer partial exemptions. But here is the catch. You have to apply for them. They are not automatic. You have to know which form to file, which box to check, which line to fill in. And the complexity of the forms is designed to discourage you. It is not an accident that these exemptions are hard to find. The states make them hard to claim because every dollar they do not collect is a dollar they have to find somewhere else. And it is not just military pensions. Disability retirement pay from the Department of Veterans Affairs is generally tax-free at the federal level, but some states will try to tax it if you do not explicitly claim the exemption. Survivor benefit plans, dependency and indemnity compensation. All of these can be partially or fully exempt, depending on where you live. If you are a surviving spouse drawing survivor benefits from a military pension, you may qualify for exemptions that the pension holder would have qualified for. But nobody is going to tell you that. For public sector retirees, the landscape is even more varied. Teachers, police officers, firefighters, and civil servants often have state-specific exemptions that nobody talks about. Illinois, for example, fully exempts pension income from state taxation for public sector retirees. But if you moved out of Illinois and into a state that does tax pension income, you lose that exemption. And you might not even realize it because you still think of yourself as having an Illinois pension. Your pension check still comes from the same source, but your tax liability has changed because of where you live. Here's a number that will shock you. According to a study by the Government Accountability Office, nearly 40% of retirees who are eligible for military or public service tax exemptions do not claim them. 40%. That is not a rounding error. That is a systemic failure of the system to inform people of their rights. 2 out of every 5 retirees who are entitled to these exemptions never see a dime of the savings because they simply do not know the exemptions exist. Let us switch to investment income because this is another area where retirees leave money on the table. Dividends, interest, and capital gains are typically taxable, but there are exemptions and reduced rates that specifically benefit seniors. The long-term capital gains tax rates are 0%, 15%, and 20%. Depending on your taxable income. If you are married filing jointly and your taxable income is under about $94,000 in 2025, your long-term capital gains rate is 0%. Zero. That means if you sell stocks or mutual funds that you have held for more than a year and your income is below that threshold, you pay nothing in federal capital gains tax. But how many retirees know that? How many retirees are sitting on appreciated assets, afraid to sell because they think they will get hit with a huge tax bill, when in reality they could sell tax-free? How many retirees are holding on to concentrated stock positions because they do not want to pay the tax, not realizing the tax would be zero? This is one of the biggest misunderstandings in retirement tax planning. If your income is in the right range, you can rebalance your entire portfolio, lock in gains, and pay zero federal tax on the profits. And then there is the net investment income tax, or NIT. That is an additional 3.8% tax that applies to investment income when your modified adjusted gross income exceeds $200,000 for single filers or $250,000 for married couples filing jointly. If you are below those thresholds, the NEET does not apply. But if your CPA is not running the numbers with and without NEET, you could be over-withholding or making withdrawal decisions based on incorrect assumptions. And here is the dirty trick. Because the NIT threshold is not indexed for inflation, more and more retirees are getting pulled into it every year. What seemed like a safe income level 5 years ago might now push you over the threshold. Qualified dividends are taxed at the same favorable rates as long-term capital gains. But if you are in a high tax bracket, they can push you into NIT territory. This is where strategic tax planning becomes essential. Selling appreciated assets in years when your income is low, harvesting losses to offset gains, timing your dividend reinvestments. These are not complicated strategies. They are basic tax awareness. But most retirees never do them. Now let us talk about medical expense deductions, because this one can save you more than almost any other exemption, and it is the most commonly missed. If you itemize your deductions, you can deduct qualified medical expenses that exceed 7.5% of your adjusted gross income. For a retiree with an AGI of $50,000, that means any medical expenses above $3,750 are deductible. If you had a major surgery, if you are paying for long-term care insurance, if you have ongoing prescription costs, if you made modifications to your home for a disability, those expenses add up fast. And I mean really fast. And here is the part that most retirees do not know. You can deduct premiums for Medicare Part B, Part D, and Medicare Advantage plans. You can deduct the cost of dental treatments, vision care, hearing aids, and transportation to medical appointments. You can deduct long-term care insurance premiums up to certain age-based limits. For someone age 71 or older, the deductible limit for long-term care premiums in 2025 is over $5,800. That is just the premium. If you actually use long-term care services, those costs are deductible too. I want you to let that sink in. If you are paying $600 a month for a Medicare Advantage plan plus supplemental coverage, that is $7,200 a year. That alone exceeds the 7.5% threshold for most retirees. But if you are not itemizing, if you are taking the standard deduction instead, you are missing that entire deduction. You are paying taxes on income that was effectively spent on medical care. The government is taxing your medical expenses. Think about how absurd that is. Now, the standard deduction for seniors over 65 is higher than for younger taxpayers. For 2025, if you are single and over 65, you get an additional standard deduction of about $1,950. If you are married and both over 65, you get an additional $1,550 each. So the standard deduction for a senior couple might be around $16,000. But sometimes, even with that higher standard deduction, itemizing your medical expenses comes out ahead. You have to run the numbers both ways. Most retirees do not. Let me give you a real scenario. A retired couple, both over 65 with an AGI of $60,000. They have $12,000 in medical expenses, including Medicare premiums, prescriptions, dental work, and a hearing aid purchase. Their medical expenses exceeded the 7.5% threshold by $7,500. They also have $6,000 in charitable donations and $4,000 in state and local taxes. Their total itemized deductions come to $17,500. The standard deduction for a couple over 65 is roughly $16,000. By itemizing, they save an additional $1,500 in deductions, which at a 12% tax bracket saves them about $180. Not life-changing, but if that same couple had $20,000 in medical expenses because of a major surgery or long-term care, suddenly itemizing saves them much more, and those savings add up year after year. Now, let me bring this all together and give you a concrete action plan. Because knowing about these exemptions is useless if you do not act on them. Action number 1. Verify how your Social Security benefits are being taxed. Pull your most recent tax return. Look at line 6B on Form 1040, which shows the taxable amount of your Social Security. Then calculate your combined income yourself. Adjusted gross income plus non-taxable interest plus half of your Social Security benefits. Compare that number to the $25,000 and $32,000 thresholds. If your combined income is below those thresholds and you are paying tax on your benefits, you need to file an amended return. You can go back 3 years and claim refunds for every year you overpaid. That is 3 years of overpayment that the IRS will return to you if you file the right forms, but only if you act. Action number 2. If you have moved across state lines since retiring, check the pension and retirement income rules in your current state immediately. Do not assume the rules are the same as your previous state. Do not assume your tax preparer automatically knows. Every state publishes its tax guidelines online. Most have specific pages for military retirees, public sector retirees, and senior citizens. Read them. If you find an exemption you qualify for but have not been claiming, file amended state returns for the last 3 years. Most states allow you to amend returns going back 3 years. Some go back 4. Check your state's statute of limitations and file before the window closes. Action number 3. Map out a withdrawal strategy for your retirement accounts. If you have a mix of traditional IRAs, Roth IRAs, and taxable brokerage accounts, the order of withdrawals matters enormously. A good rule of thumb is to withdraw from taxable accounts first in low-income years to take advantage of the 0% capital gains rate, then use Roth IRA withdrawals in high-expense years, and take traditional IRA withdrawals only when you need to fill gaps. But the exact strategy depends on your specific numbers. Run a projection. Use a tool like the IRS's tax withholding estimator or a retirement tax calculator. Or better yet, hire a fee-only fiduciary who specializes in retirement tax planning, not a commission-based advisor who sells products, a real planner who runs the numbers. Action number 4. Review your investment holdings for opportunities to tax loss harvest and to realize long-term capital gains in years when your income is low. If you have stocks that have appreciated significantly and your taxable income this year is below the $94,000 threshold for married couples, consider selling some of those positions. You will reset your cost basis higher and pay 0 federal tax on the gains. This is called a tax gain harvest, and it is the flip side of tax loss harvesting. It only makes sense in years when your income is low enough to qualify for the 0% rate. But if you are in that window, it is free money. Action number 5. Track every medical expense. Every single one. Medicare premiums, prescription copays, dental visits, eyeglasses, hearing aids, transportation to appointments, long-term care insurance premiums. Keep a spreadsheet, a folder of receipts, or use a medical expense tracking app. At tax time, total everything and compare your itemized deductions to the standard deduction. If you have had an expensive medical year, itemizing could save you a lot, and do not assume that just because you took the standard deduction last year, you should take it again. This year, every year is different. Action number 6. If you are a military retiree or a public sector retiree, go to your state's Department of Revenue website right now. Search for Military Retirement Exemption or Public Pension Exemption. Find the specific form you need to file. If you qualify and have not been claiming it, the worst they can say is no, but the best case is thousands of dollars back in your pocket. And if you are not sure whether you qualify, call them. The phone number is on the website. Ask a human being. They are actually allowed to help you if you ask. Here is the reality check I want to leave you with. The tax code is not designed to help you. It is designed to collect revenue. The exemptions, deductions, and exclusions that exist in the tax code are not there because the government wants to be generous. They are there because enough people lobbied for them. And now they are on the books. But nobody is going to hand you those savings. You have to reach out and take them. Every year, millions of American retirees collectively overpay billions of dollars in taxes that they did not legally owe. The IRS does not return overpayments automatically. The states do not send refund checks unprompted. The money sits in government coffers, spent on other things, while seniors choose between medication and groceries. The Taxpayer Advocate Service reports that millions of taxpayers overpay every year and never claim their refunds. Billions of dollars in unclaimed refunds just sitting there. You worked 40, 50, 60 years of your life to build that retirement nest egg. You sacrificed, you saved, you played by the rules, and now the system that is supposed to support you in retirement is quietly taking money from you that it has no right to take. That is not just frustrating, it is wrong. It is morally wrong. And the only person who can stop it is you, not your financial advisor, not your CPA, not your children. You. Do not be like Richard, sitting in that tax preparer's office, doing the math on 6 years of overpayment and realizing that $24,000 is gone forever. Be the person who checks. Be the person who asks questions. Be the person who reads the fine print. Because when it comes to your retirement income, the difference between financial comfort and financial stress is often just a few $1,000s a year. And those few $1,000s belong to you, not the government. That is all for today. Thank you for watching.